You are almost certainly paying for insurance you will never use, and quietly missing the one policy that could actually save you. Most people have insurance exactly backwards. They overpay every single month to protect the small things they could easily replace out of pocket, while leaving the one thing they genuinely can't afford to lose barely covered at all. It feels responsible. It feels safe. But a lot of it is just money leaking out the side, month after month, for a peace of mind you were never really buying. So let's straighten it out. The coverage you're wasting money on, and the one policy most people are missing entirely. Before we get into it, if calm, no-nonsense money that respects your time is what you're after, take a second and subscribe. This channel is a few plain English money breakdowns a week, no hype and nothing to sell you. Okay, let's talk about what you're overpaying for. Here's the one idea that quietly fixes almost everything about insurance. Insurance is not supposed to protect you from every little cost. It exists for one job: to cover the catastrophe you could not possibly pay for yourself. A small dent you can fix, a phone you can rebuy, a $500 repair you can absorb, those are inconveniences. You can handle those. A home you lose, a lawsuit that follows you for years, an income that stops for 18 months, those are catastrophes. And most people spend their insurance money doing the exact opposite of what makes sense, paying extra to cover the small stuff, while skimping on the coverage for the things that would truly wreck them. Once you see insurance this way, big catastrophes, yes. Small inconveniences, no. Almost every decision gets simple. So here's the first place you're overpaying: deductibles that are set too low. Your deductible is the part you agree to pay yourself before insurance steps in, and a lower one feels safer, because you'd pay less if something went wrong. But you pay for that comfort every single month, in a higher premium, whether anything goes wrong or not. Picture the same policy two ways. With a low deductible, you might pay a couple $100s more a year than you would with a higher one. Go several years without a claim, and most people do. And you have slowly handed over hundreds of dollars to protect yourself from a one-time cost you could have covered anyway. Raising your deductible to the most you could comfortably pay from savings is one of the simplest ways to shrink a bill you're overpaying, as long as your emergency fund can quietly absorb the gap. Second, insuring things you could simply replace. This is the whole world of extended warranties, phone protection, appliance plans, and that little add-on offered at every single checkout. Here's the quiet truth about nearly all of them. They are designed to be profitable for the company selling them. On average, these plans collect far more in fees than they ever pay back out in claims. That is not a scandal. It is just the business. But it means the odds are gently stacked against you every time you buy one. If your phone cracking or your blender dying wouldn't be a real emergency, just an annoyance, then you don't need to insure it. You come out ahead by keeping that money and quietly becoming your own warranty. If this is already changing how you see that little checkout question, that's exactly the point. Subscribe so the next breakdown finds you. And let's keep going, because these next few are the ones that quietly cost people the most. Third, the loyalty penalty. There's a comforting myth that staying with the same insurance company for years quietly earns you a better deal. Very often, the opposite is true. Plenty of insurers count on you never checking, so your premium drifts upward year after year. A little bump here, a small increase there, while a brand new customer walking in the door is offered a lower price for the very same coverage. Loyalty in insurance is frequently just a fee you pay for not shopping around. Getting a few fresh quotes every year or two and calling your current company with them is one of the best paid hours in your entire financial life. People routinely knock real money off a single bill just by asking. Fourth, paying for coverage you have outgrown, or paying for the same thing twice. Insurance should match your life as it is now, not as it was the day you signed up. The classic example is full crash coverage on a car that's now worth very little. Keep it long enough, and the premiums can quietly add up to more than the car would ever pay you back if it were written off. At some point, that coverage is guarding a catastrophe that simply can't happen anymore. Doubled up coverage is the other silent leak. The rental car policy you buy at the counter, when your own car insurance or your credit card may already cover it. Or the tiny plan buried in a loan you forgot you were paying for. Once a year, it pays to actually read what you already have. because you can't stop paying for something twice until you notice that you are. And fifth, the big one, buying complicated insurance is an investment. Some policies are sold as a clever way to protect your family and grow your money at the very same time. Two different jobs, bundled into one expensive product, wrapped in fees and fine print most people never finish reading. For a great many families, the simpler path is to keep those two jobs separate, cover the real risk with plain, inexpensive coverage, and invest the difference yourself. This isn't a rule for every single person, and real exceptions do exist. But when a policy is confusing, costly, and was sold to you very hard, that's usually a sign to slow down and ask what you're actually paying for. Insurance and investing are two different jobs, and blending them tends to just make both of them cost more. So that's where the money quietly leaks out. Now here's the one policy most people are missing entirely. And it happens to protect the single most valuable thing you own. It isn't your car. It isn't even your house. It's your income, your ability to wake up and earn a paycheck. Add up everything you'll earn over a working lifetime, and it's a genuinely staggering number. Someone earning $50,000 a year across 30 years will bring in around $1.5 million. That steady stream of income is the engine that quietly pays for all of it. The home, the savings, the retirement, the whole life you're building. And yet almost everyone carefully insures the car and the phone and leaves the engine itself completely uninsured. The policy that covers that engine is disability insurance. Coverage that replaces part of your paycheck if an illness or injury keeps you from working for a while. And this is not some rare, far-fetched risk. Researchers have long estimated that more than 1 in 4 of today's younger workers will go through a stretch of being unable to work before they reach retirement. You are far more likely to lose your income for a time than to have your house burned down. And yet the house is insured down to the dollar while the paycheck usually isn't. Many people can actually get some of this coverage through their job, often surprisingly cheaply, and never sign up simply because nobody ever explained what it was really for. So start there. Check what your employer already offers before you shop anywhere else. It is the quietest, most overlooked protection in all of personal finance, and it guards the one thing everything else depends on. So here's how to put all of this to work this week, without turning into an insurance expert. First, raise the deductibles on your car and home to the highest amount your emergency fund could comfortably cover and pocket the lower premium. Second, cancel the small stuff. The extended warranties and gadget plans covering things you could simply replace yourself. Third, get a couple of fresh quotes on your big policies and make your current company earn your business instead of assuming it. And fourth, plug the real gap. Look into disability coverage for your income, starting with whatever your job already offers. 4 moves, 1 quiet afternoon, and not a single one of them asks you to earn $1 more. Because the calm truth underneath all of this is simple. Insurance was never meant for the small stuff you can absorb. It's for the catastrophe you can't. Stop overpaying to cover the little inconveniences and start covering the handful of things that could genuinely knock your life off course. Do that, and you'll very likely spend less and be better protected at the exact same time. If this made insurance feel a little less like a maze, subscribe and stick around, because next up we're breaking down buy now, pay later, the kind of debt that doesn't quite feel like debt until one day it quietly has you. This is general education, not financial advice. So check your own policies and your own numbers before you change anything. I'll see you in the next one.